Hello and welcome. So, in this video, I'm talking about the taxation of stock options and restricted stocks in US. Right. Let us start. So, just a disclaimer before that the US tax on stock options and restricted stock is a bit complicated. I'm not a US CPA, so this is just based on my learnings and understanding. It's an overview video. There are finer aspects to it, so please take professional advice from a CPA on this matter. Okay, so let us start. So there are basically how many types of plans? Let us discuss. So one is the stock options that you have, right? The stock options that are given. Now, stock options are of two types. One is the non-statutory stock options, and second is the statutory stock options for tax purposes, right? The taxation is different, right? Now there are many variations with respect to the these employee compensation schemes that are given, but from a tax perspective, the the it is divided into 2 points. Either it's a non statutory option. A statutory option is again divided into two, which is stock option is treated differently, and the employee stock purchase plan is treated differently. And then if it is not a statutory option, it is taxed as a non-statutory option, the taxation of which is again different. Then you have restricted stock, which is either in form of RSU or in form of RSPAs, restricted stock award programs. That is different. And then there are other variations also, like phantom stocks or stock appreciation rights and all, which I will not cover for the sake of keeping this video simple. Maybe I will cover it in some other video. Then what to do about taxation of stock options and restricted stock that you've got in US after return to India? That is again a deep topic, which I will cover in a separate video. This video is restricted towards only the taxation in US of stock options and restricted stock, right? So let's first discuss the non-statutory options, then we'll come to statutory options. Now, if you have received non-statutory options, the income, so there is this thing about when the income is to be recognized, right? So the income and timing depends. The fundamental point is whether the fair market value of that particular option is determinable or not. Again, if the fair market value is determinable, that means the company that has given you the option, uh, the it is like a listed company. It's like Amazon or something, and it has given you the option where the shares are already listed. What is the price at a particular date. Then it is taxed as salary income at grant stage itself, subject to restricted property rules. Restricted property rules is that the taxation will be only happening once the shares are substantially vested. Again, how the word substantially vested is again defined, right? That means there should not be a risk of forfeiture. It should substantially, you have the right to transfer that stock, so those conditions are there. So basic point is that it will be subject to tax at the earliest. That means generally stocks are not transferable at not taxable. These compensation mechanisms are not taxable at grant stage, because there is generally a cliff period of say 1 year, and after that, basis certain conditions, the options vest, right? So the taxation generally starts from vesting, right? But here the rules, the Internal Revenue Code states that the taxation will be done at a grant stage subject to restricted property rules. That means the taxation will be deferred till the stocks become substantially vested. And here the one important thing is that there is no benefit of 83B election. So in US generally, if you have like incentive stock options or certain restricted stocks, you can make a 83B election whereby you say that the s- stock will be taxed at the grant stage itself, whereby there is no taxation at vesting, there's no taxation at exercise, there's a then the taxation is only at the sale of the stock. But that option, that benefit of making a section 83B election, is not available with respect to non-statutory options. Then talking about a situation where the FMV is not determinable. So if the FMV is not determinable, the FMV, it becomes taxable. The FMV minus whatever you have paid for that option becomes taxable when the option becomes substantially vested. Now, by the time the option becomes substantially vested, generally it becomes the fair market value can be determined, because generally there are requirements that you need to get a 409 valuation done in case of unlisted stocks. So by that time, when the option becomes vested, FMV becomes determinable, and at that time FMV minus whatever you have paid for that option becomes taxable as salary income, right? And then, so this is the income as a recognition as a salary income as part of your W2, depending upon the fair market value, determinable or non-determinable. Then once the shares have been issued to you, you have the substantial right over the shares. You can transfer the shares. The sale of the option, or basically it's the sale of the share, there are no special rules for that. It is taxed as per the normal capital gain provisions. If you sell within 1 year, it is taxed as a short-term capital gain. If you sell after 1 year, then it is taxed at 0%, 15%, 20%, depending upon the your income slab where you are. Now the basis, or in India what we call it as the cost of acquisition, is the amount that you have paid for that particular option, and the amount that has been included as income, as your salary income at the time of the grant or exercise. So the sum of two is the basis, and the sale price is the sale price, and then you calculate the capital gain accordingly. So this is the taxation for non-statutory options. Now let's now let's come into discuss what is the taxation of incentive stock option. Now, incentive stock option is only given to employees. It's only for the employees either of that company or any related company. That means any kind of subsidiary or a related enterprise of that enterprise. Only to the employees of that those companies it can be given. And that one other requirement is that the person has held the options for a certain amount of time. So there are certain restrictions as to the holding requirement with respect to the person has to have held the options for a certain amount of time for it to qualify as an incentive stock option. Now in that case, incentive stock option it gets a or the ESPP. So both fall into the statutory stock option. They get the advantage of being, there is a certain tax advantage that these kind of options get as compared to non statutory stock option, which becomes taxable at the grant stage itself. And there is no 83B election here. There is no taxation at the grant. There is a 83B election also that you can make to reduce your tax liability. So at the grant of the option, there is no tax liability. At the exercise of the option, also there is no tax liability. However, there is an AMT as an alternate minimum tax adjustment that may be required if the FMV at the time of exercise minus the exercise price that you pay for the exercise uh, is there is a spread, significant spread is there, and the right to the in the stock is established. In that case, there is an AMT adjustment that may be required. However, there is no AMT adjustment if you dispose of the stock in the same year that you exercise the option. So that again benefit is there, which you can consider while selling your options to reduce your tax liability. So that you have to sit with your financial advisor or your tax advisor to decide at what time you need to kind of sell the shares to have the least uh, uh, tax liability for that particular year. Now, at the time of sale of the stock, again, there is a, as I said, there is a holding requirement, a minimum time that which you need to hold the stock. I'll come to what is the holding requirement. So, holding requirement, which is HDR, I've just used it for simplicity. So, if you have met the holding requirement, then the capital gain or loss you'll have to recognize, and the sale value of the stock minus the option exercise price. If the holding requirement is not met, then it will be the whatever is the gain or loss that will be recognized as a ordinary income. So the benefit of it, you be recognizing it as a capital gain, is that it will be taxed at a uh, reduced rate of 0, 15 and 20%, as compared to if you are like in the highest tax bracket of say 37%. Then instead of it being taxed at 37%, the capital gain, if the holding period requirement has been met, it will be taxed at whatever as per the lower rates. What is holding period requirement is that the stock should be held till later of 1 year after the stock was issued, or 2 year after the option was granted. So you must have held the stock till later of these of the two dates. Then you are said to have met the holding period requirement. Now, it is not just that you meet the HDR and so as to qualify for a lesser capital gain. You need to see it from all angles. Generally, to avoid concentration risk, you may even decide to dispose of the stock in the same year that you exercise the option, that's and pay a bit higher capital gain. That again is a choice, conscious choice that you need, that you may exercise. So you have to see this whole thing not only from a tax point of view, but from an overall holistic financial planning point of view also. And this is where your financial advisor also comes in the picture, and he can advise you with respect to your complete finances. Okay, then so this is for ISO, incentive stock option. Then let's come at employee stock purchase plan, ESPP. Now, again, this is also tax advantage where at the time of grant of the option, there is no tax liability. At the exercise of the option, there is no tax liability. Now, on the date of the sale, if the HDR is met, then it is basically lesser of the. Again, it's a now this is very complicated, right? So you need to check with the CPA. I'm just giving an overview of the provisions. The taxation is lesser of two things: FMV minus option price at the date of grant, at the time of grant, or the FMV minus price paid per share at the time of exercise. Lesser of the two is taxed as ordinary income, and sale price minus FMV at the time of exercise is taxed as capital gain or loss. It's complicated. So if you have met the holding period requirement, then this is what is the taxation system. If you have not met the holding period requirement, then FMV minus option price at the time of exercise is taxed at ordinary income, and sale price minus FMV at the time of exercise is taxed as capital gain or loss. So that is the the treatment, the tax treatment. So this was about employee stock purchase plan. Now let's come to restricted stock. Now restricted stocks, a lot of companies now prefer giving restricted stock. What I understand is that, like in India, you can only give a ESOP as an option under the ESOP plan, but in US it is different. You can also give shares under the ESOP plan. So companies generally prefer to give RSU or RSPA, restricted stock purchase, restricted stock purchase awards, restricted stock awards that are generally given. So what is the taxation? Again, they are favorably taxed, so there is no tax liability till they are substantially vested. What is the meaning of substantially vested is, well, generally when the companies give a restricted stock, they have those conditions that the stock, there is a cliff period of 1 year, and then there is a vesting requirements that the stock will not be vesting. There is a vesting schedule. So till the time the stock is not vested, that means you do not get the right to transfer the stock to someone else, and there is, till the time there is no significant risk of forfeiture. That means even if the company has given you a stock, like 1 lakh RSUs, you may, if you are terminated, you may, the company may uh, you know forfeit, or if you leave the company they forfeit. But at one point where there is no restriction on the transfer, and there is no restriction, no risk of significant risk of forfeiture, at that time it is considered as substantially vested, and the tax liability arises. So at the time when it is vested, the FMV of the share minus the amount that is paid is considered ordinary income. The income is subject to federal plus state tax. So one is the federal tax, other is the state tax, plus the applicable rate, plus the social security, Medicare tax. Employer will deduct the number of shares corresponding to the tax. So here in RSU RSPA, what happens is that the employer will deduct the number of shares corresponding to the tax prior to crediting the shares in your brokerage account, right? So if there were like 10 shares that the employer has to give you, and on that, whatever is the FMV minus amount paid, whatever is the tax liability, there is 2 shares. So employer will credit only 8 shares in your brokerage account, right? As a withholding, 2 shares will be the withholding, and rest will be credited in your brokerage account, which you can then sell. Now, as per the sale, it is subject to the normal tax rules. The capital gain will be there, less than 1 year reduced rate, sorry, less than 1 year normal ordinary income, more than 1 year 0, 15, 20%. Now, there are backup withholding rules that will apply. So, if there is no ITIN or a W8 BEN on file, there is a 24% backup withholding will apply. So either you have to furnish a ITIN or a SSN to your broker. uh, that should be on file before the sale happens. Or you should be, if you have returned back to India, you should have furnished a W8BEN to the broker, so that they do not deduct the 24% backup withholding tax. Because if there's a backup withholding that has been deducted by the broker, then uh, in India taxation, it is very difficult to then get the credit of that backup withholding, right? So you need to be careful to furnish this, so that there is no 24% backup withholding that applies. Dividend will be taxable in the year it is given. Now, if there is a company has a vesting schedule, so the shares have not yet been vested fully. However, every year you may get a dividend. Generally startups, they don't give dividend because there is no profit. But if the company is profitable and they give the dividends, then even if the dividends are given in respect to us restricted shares for which the income has not been recognized because they have not been vested, still the dividend, if any, given on those shares will be taxable in the year that is given, even irrespective of the fact whether the stock was vested or not. Now, here there's a very good way that you can plan, is that you can make a Section 83B election. 83B is basically one of the sections in the Internal Revenue Code. So you can make an election under 83B of the Internal Revenue Code to the IRS with a copy to the employer, but that election you have to make within 30 days of the grant. If you miss that time period, then you cannot make. There is no kind of uh, provision that you can delay or a condonation of delay. I don't think so. Those provisions are there. You have to make it this particular election within 183, within 30 days of the grant. Now, the effect of this election that you make is that the FMV at the time of the grant, which is like in case of startups and all, it's very, very low FMV, right? So, FMV minus whatever you price that you pay, right? So, if you pay the same price as what is the FMV, then there is zero taxation at the time of the grant, or the FMV is taxable at the time of the grant, and no tax at vesting, no tax at when the shares vest to you, because at the time of vesting, generally the stock value significantly appreciates depending upon when the vest happens. So you kind of plan your tax in such a way that you pay a very less or almost nil tax at the time of a grant, making that election 83 election 83B election to the to the IRS. So no tax at the time of vesting. The basis for the capital gain is the amount that is considered as taxable income plus what you have paid to the employer for the shares. So that's the tax planning you can do. Now, the pro of this is that there is a lesser tax outgo if the fair market value of the at the time of the grant is less as compared to the vesting. However, the con here is that if the at the time of grant the stock values have the value per share of the company has been significant, has is now significant, and then the company fails, maybe later on the company fails, you cannot recover the tax that you've paid at the time of grant, right? So that is a problem. But if it's a very early stage company, the prospects of the company look good, the company has just been formed, FMV is very low, it's a very, very useful thing to make an election. However, the one more con is that if you are an Indian resident who is subscribing to a unlisted company in US and making an 83B election, at the time of vesting, India will still tax you at the time of vesting. India will disregard the 83B election that you have made in the US. So the tax liability in India will still be there. So if you want to avoid the India tax liability, you have to become a non-resident as per the Indian tax law. If you feel that a significant tax liability can arise at the time of the vest, uh, and you are a resident, Indian resident, tax resident, so that again you'll have to think through if it's a cross-border case. Yes, so this is it. I hope this was useful, and do please share your thoughts, comments in the comment section. Thank you so much for watching this video. Thank you so much.